This is Mark to Market, a podcast of BT correspondents.
Hello everybody, I'm benpaul. Welcome to Mark to Market, a BT correspondence podcast. Frasers Property Ltd, or FPL, unveiled a proposal in June to optimize $2.1 billion worth of hospitality assets held by Frasers Hospitality Trust, which was taken private last year. The main thrust of the optimization plan, as I see it, is that FPL will unlock value from the most mature and low-yielding assets held by Frasers Hospitality Trust by essentially selling them to its own controlling shareholder, while still continuing to manage them. FPL will also consolidate full ownership of Frasers Suites Singapore, which will facilitate a potential redevelopment of the whole Valley Point site. This optimization plan, because of the involvement of FPL's controlling shareholder, is an interested party transaction, so it will be put to a minority shareholder vote shortly. In the meantime, FPL shares, which some analysts have said are trading at an unjustifiably deep discount to the value of its underlying assets, haven't budged since the optimization plan was announced. Is the optimization plan as positive as it sounds on paper? Why hasn't the market reacted more positively? And what is FPL doing to address its weak share price? To discuss all of this and more is Loo Choo Leong, the Chief Financial Officer of FPL. Choo Leong, thank you for being here today. There are a lot of things I would like to discuss, but let's start with the optimization plan for the Frasers Hospitality assets. Can you explain why it was proposed and what feedback have you received from investors so far?
Pleasure to be here, Ben. In essence, we are selling, like what you've said earlier, the mature and lower yielding hospitality assets on a portfolio basis to our existing co-owner, namely TCCGI, at a price above both the latest independent valuations and the implied valuation from the privatization of Frasers Hospitality Trust, or FHT for short, in 2025. TCCGI is a natural counterparty because they are the co-owners, but we tested the market before we concluded on what's the best route to optimize this portfolio. The starting point was the privatization I mentioned earlier. Taking FHT private gave us far more flexibility over how the hospitality portfolio is going to be owned and structured. We then undertook a comprehensive review of the portfolio. Some assets are mature and stabilized. They're good assets, but they are lower yielding. Other assets still have meaningful upside potential, hence we continue to keep a part of it. In addition, we saw an opportunity to secure full ownership of Frasers Suites Singapore, which could support the longer-term redevelopment potential of the wider Valley Point site.
Was there no other alternative to doing this deal with your controlling shareholder?
We did explore various possibilities with our financial advisors. The board looked at execution certainty, timing, platform impact, and long-term outcomes. We ran market checks through our advisors with credible third parties. No party was prepared to transact on comparable terms while allowing us to retain our management role and the fee income.
Okay. When assets are shuffled between a listed company and its controlling shareholder, there are often concerns about whether minority shareholders are being disadvantaged in some way. How are the interests of minorities being protected in this instance?
Well, I'm glad you asked. Governance was paramount for the whole process. Conflicted directors abstained fully from the discussions. An independent financial advisor was appointed, and TCCGI will abstain from voting at the EGM. Ultimately, independent shareholders decide the outcome, not the controlling shareholder. On the economics, the transaction was negotiated above both the latest independent valuations and the implied take-private valuations, which we believe represents a positive outcome for FPL's shareholders.
So that sounds like a really good deal. And in some ways, it sounds almost too good to be true. Why was FPL's controlling shareholder willing to support its listed company in this manner?
Well, I would not characterize this as a controlling shareholder simply supporting the listed company. The transaction works because both parties see value in it. TCCGI will get to increase exposure to assets that suit their long-term objectives. Frasers Property unlocks capital, improves capital efficiency, and keeps the management income while creating future value creation opportunities. As for why we continue to manage the assets, that reflects the strength of Frasers Hospitality's platform, deep operating capabilities, an established network, and a track record across multiple markets.
So why do you think the market hasn't reacted more positively to the announcement of this deal?
We are very aware that shareholders want to see value reflected in the share price. However, share prices are ultimately determined by the market, and markets don't always react immediately to the long-term implications of a transaction. On a portfolio basis, the transaction was priced above the latest independent valuations and the implied value from the take-private transaction. The capital comes back to the balance sheet and we improve our net gearing while retaining the recurring income in the form of management fees. This transaction moves in all the right directions for FPL.
Do you feel that minority investors are with you on this deal? I mean, when you think back to the privatization of FHT, it only succeeded the second time around, even though in both instances the offer price was above NAV. So, investors are kind of resistant to letting go of good quality assets. What would you say to an investor who's sitting on the fence right now when it comes time to vote and they're not sure which way to go?
Firstly, the potential Valley Point site development has full upside for FPL. Secondly, by selling the lower yielding mature assets, we actually free up capital that can be invested in higher return opportunities. Yet, we get to keep managing these assets and earn the fee income while bringing down our net gearing. That is not a trade-off. Normally, you sell an asset and the future recurring income goes with it. Here, the capital is unlocked, improving key financial metrics while preserving recurring income. So it ticks all the right boxes for FPL and its minority shareholders.
Choo Leong, with Frasers Hospitality Trust having gone private, how does FPL intend to recycle capital out of its mature hospitality assets going forward? Will it continue to turn to its controlling shareholder, or are you looking at some other means of doing this?
This transaction is specific to the FHT portfolio. There is no cookie-cutter approach to each property. Those that we have on our balance sheet, we will continue to either hold on to them, sell to third parties like what we've done in the past, or enhance the asset through asset enhancement initiatives. We will look at it from an asset management perspective individually. So there are various options, not necessarily to our sponsors.
So the hospitality business is still a growth business for FPL going forward?
Yes, certainly. The AUM remains and it will continue to grow in a more capital efficient manner and to generate better returns whilst building on our continued capability in this asset class.
Choo Leong, there was a time in the years leading up to the pandemic when REITs performed very, very well. Interest rates were low, and frankly, the rest of the stock market wasn't performing that well, so they were very popular. With interest rates now higher than they were before COVID, the performance of REITs as a whole has waned. Is the REIT model still central to FPL's strategy?
It is very clear to us that REITs remain central to how we operate at Frasers Property. While the funding environment has changed, the model has not. We have recycled close to $10 billion worth of capital via our listed REITs since 2014. REITs remain our preferred capital recycling platform for many mature assets. They do sit alongside a wider set of capital recycling options, as in the case for most of real estate market players. Our REIT platforms have helped us recycle capital, grow our asset management business, and create value for both FPL shareholders and REIT unit holders. The way we think about capital recycling today is broader than it was 10 years ago. In many cases, the answer may well be one of our REITs. In other cases, it could be from a growing pool of institutional capital, private capital, and strategic investors looking for high-quality real estate exposure or a different structure.
But those alternative channels for monetizing your assets would also be affected by higher interest rates, wouldn't they?
True. However, different pockets of capital providers will have different returns requirements depending on their strategies as well. Some for wealth preservation purposes, some want exposure in certain asset classes or certain geographies. So there are different objectives from different capital providers.
The Mark to Market podcast will be back right after this.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Market, a podcast of BT correspondents.
Welcome back. This is the Mark to Market podcast. I'm benpaul, speaking with Loo Choo Leong, CFO of Frasers Property. Choo Leong, I would like to talk a bit about the overall decline in ROE that property companies like FPL have experienced over the past decade, and the shifting investor perception of commercial property and of property developers. I think we're both probably old enough to remember the impact on youth culture that the Centre Point on Orchard Road had when it first opened in the early 1980s. Shopping malls of that sort were really a new thing at the time, and it became a place for young people to socialize and spend money that the previous generation didn't have. Real estate development seemed exciting back then because it seemed to be changing the way we lived. But that was before social media and e-commerce. And those trends have started to affect retail and dining businesses. And similarly, with trends such as work from home and digital nomad traveling, there now seems to be some ambivalence about demand for office space and hospitality properties. How is FPL repositioning itself in the face of changing business and cultural trends in order to maintain its overall profitability and its attractiveness to investors?
Well, those are very good points that you've made there, Ben. And I must say that they have been in our minds for many years now, especially during the last global pandemic. What creates value is having the capability to continually improve our assets sustainably and the discipline to deploy capital where it can generate the best risk-adjusted returns. And this includes redevelopment if or when it is sensible to do so. Let's start with retail. It has changed the most. If a mall is simply a collection of shops, it will struggle. The ones that work are places people go to meet, eat, exercise, and spend time. They are places for experiences, convenience, and community. Demand for offices has not disappeared. Instead, demand has become more selective and moved towards quality, well-located, sustainable buildings that help companies attract and retain talent.
You said something very interesting. A mall is not simply a collection of shops. And yet, when we report on the performance of REITs, for example, we tend to ask about the hard metrics, about occupancy rates and rent reversion and the cost of debt and so on. Are we asking the wrong questions when we cover these things? Should we be talking about the ability of malls to serve the broader community and what it does for that catchment area?
Well, the metrics that you mentioned do matter. However, that's not all. It's how the properties serve the community as well. These contribute to sustainability and resilience of the properties that we manage. For example, for retail, we do have community events and promotions that look at health and wellness. These are the spaces that people use and are meaningful to communities that we as real estate players provide in the markets that we operate. So we do go beyond just the financial metrics that you've mentioned.
So it sort of feels like there's some experimentation going on when you talk about these new activities that go on in these public spaces. With shifting tenant preferences and shifting consumer preferences, does it require more frequent and more expensive asset enhancement initiatives in order to keep these properties relevant?
Yes and no. There will be some investments required, of course, but not all require outright capital funding. I wouldn't say just experimentation. We do have the experiment, but it's continuing to evolve and improve over time, taking into account what we know about our customers, and they include the community, not just those who are our tenants or visiting our malls.
When you look at the decline in ROE for property developers in general over the past decade, what is the reason for that decline? What was the single biggest factor? Was it property cooling measures, or was it some declining return on commercial property assets?
Improving returns is a major focus for us. We are being deliberate with where our capital sit instead of simply waiting for the cycle to turn. Moving lower yielding assets out of our direct balance sheet and redeploying the capital into higher returns projects or assets. Higher for longer interest rates do affect overall returns. That's the reality of it. And certain development earnings do take time to come about. We constantly ask ourselves whether an asset is earning enough to justify the capital invested in it and whether we can create more value. You've seen that discipline across our group. In Australia, we sold stabilized retail and industrial and logistics assets and put the capital into our redevelopment or development pipeline. In Singapore, we launched Dunnan House, the residential development project, and joined a consortium that recently won the Bayshore Drive integrated development site. That is the same thinking that we have across all our asset classes.
So it sounds like individually all of these projects are meeting your return hurdles. But yet, and again, it's not just FPL, but ROE across the board is lower than it once was.
So we are a large portfolio. The ones that we entered into recently that I mentioned would need to meet our hurdle rates. But at the same time, we do have legacy portfolio that were entered into during different times. What's important is actively looking at them and recycling those in and out, like what I mentioned earlier about exiting those which have come to a point in the real estate cycle where they're no longer high yielding or no longer giving us the returns that we hope to generate given current circumstances where interest rates are and where the markets are.
Choo Leong, let's talk about FPL's share price. FPL is currently trading at less than half its net asset value. It also has a rather narrow free float, and it hasn't re-rated as significantly as City Developments and UOL Group over the past year. Is the undervaluation and narrow free float something that you and the rest of the senior management think a lot about? And what are you doing about it?
I'd like to refer to the quote you mentioned at the beginning, unjustifiably low valuation. The gap between our share price and the underlying value of the portfolio is something the board spends real time on. The only sustainable way to close it is through disciplined execution. And this transaction improves the returns, capital efficiency, and net gearing at the same time. Most Singapore developers trade at a discount to NAV. The degree of discount varies, and in our case, investors often point to our relatively narrow free float, like what you mentioned, and trading liquidity. As management, we focus on what we can control: capital efficiency, net gearing, returns, capital recycling, and portfolio quality.
Some analysts see the redevelopment of Centrepoint and Valley Point as potential catalysts for a stronger valuation for your shares. Specifically, they see these projects adding about 50 cents per share to their RNAV estimates, which is nearly half of FPL's current share price. Do you expect these projects to be a driver of FPL shares going forward?
I can see the case for what you have just mentioned, but would be cautious about resting the investment case on any single project or catalyst. Value comes from the execution of development, redevelopment, active asset management, capital recycling, and partnerships over and over, of course, with improvements in many, many years. We are confident of our capabilities, as you can see, based on our track record, but we still need to do what needs to be done.
The deep discount at which your stock is trading almost feels unsustainable. If we look forward 5 years from now, what is FPL going to look like? Is it going to have a higher ROE and a more vibrant set of assets, or would it have gone private by then?
I would expect Frasers Property to continue evolving and improving, just like what we have done over the past decade. We are focused on getting better returns sustainably, a more efficient capital structure, and lower net gearing over the next 5 years. That's what we are committed to deliver. The strategy and portfolio will undoubtedly look different because markets change. Customer needs change and opportunities change. Our job is to keep adapting alongside them. What will not change is a philosophy, which is to create, sustain, and unlock value. Our job is to focus on this, which we can control: improving capital efficiency, strengthening returns, allocating capital effectively, and creating long-term shareholder value. If we do that consistently, the business will continue to strengthen, and ultimately, the value we'll create should be reflected over time in our share price.
Choo Leong, thank you very much for making the time for us today.
It's been a great discussion, Ben. Thanks a lot for having me.
That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. This episode was produced by Nicole, Chieh, together with our editor Claressa Monteiro, and it was written and presented by me. Thank you for listening. I'm benpaul.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.